afternoon, everyone, and welcome to today's online roundtable hosted by REFIRE and Targa Communications. Today's discussion is focused on the office market, and we will be asking, has the pandemic changed the sector forever? My name is Barber, and I'm Managing Director of Targa Communications in London. One of the biggest social impacts brought about by the pandemic has been seen in the office sector. Since the start of the pandemic, we have all been part of what some commentators have described as the great remote working experiment. COVID-19 has changed the way in which we look at how we connect with our colleagues, business partners and customers. It has also affected our thinking about where and when we do work. Do we really need to be in the office 5 days a week? The latest research from Remit Consulting, based on the daily occupancy rates from major offices in the UK, shows that Tuesdays, Wednesdays and Thursdays are the days that see the most people at their desks, confirming the popularity of a hybrid model with a mix of remote and office-based working. It has been suggested that the choice to work remotely may become a factor in the war for talent, with individuals choosing to work for businesses that are willing to adopt such patterns of work. Whilst this might have a negative impact on the demand for office space, it is also arguable that in order to attract staff into the office, businesses will need to offer an attractive and safe working environment where health and well-being are given more importance than before. Observers suggest that offices may look like giant coffee shops, and that this will see actually greater demand for space. In order to address whether the pandemic has changed the office sector forever, we have today assembled a panel of experts to analyse and discuss the topic. And we are joined by 𝗀𝗲𝗹𝗀𝗍𝗃, who is Head of Research and Strategy at Europa Capital Partners LLP. We also have Marcel Silak, who is CEO for 𝗀𝗽𝗲𝗃𝗍𝗃 in Germany. And our final panelist today is Stefan Shah, the Managing Director and Head of Investment in Germany for 𝗀𝗽𝗲𝗃𝗍𝗃 Real Estate Investment Management. We are also joined today by Tom Leahy, a Senior Director at Real Capital Analytics, who will shortly be setting the scene, providing us with an overview of the office market in Germany, looking at the latest trends within the investment market. Once again, our lead moderator for the roundtable is Charles Kingston, who is CEO of REFIRE magazine, which is recognised as the leading source of information on German real estate finance for institutional and international investors. I would like to extend a warm welcome to all our panellists and to everyone joining us today. And so to get us started, I would now like to hand over to Tom Leahy of Real Capital Analytics to provide us with a brief overview of the office real estate market in Germany. Tom.
Thank you, Andrew. Yes, I'll just share my screen and then we can get cracking. Okay, so yes, perfect. Okay, so you should all be seeing my screen now. I'll set my timer for 7 minutes, which is the time I've been allotted. Okay, so yes, as Andrew said, I work for Real Capital Analytics. I'm based in London, but with a remit that covers the whole of Europe. And Andrew and the other organisers have asked me to talk to you relatively briefly about the German office market from the investment transactions perspective, which is RCA's specialty. You know, we track real estate investment transactions all around the world and everywhere in Europe, over 5 million euros. So that's going to be the topic of my presentation. And I've got, I think, 5 or 6 slides to go through in the next few minutes. Okay, so just to kick off, diving straight into the investment volume numbers. What are we seeing in terms of German office investment transactions? And I've got the data going back to 2007 here, which is the history that RCA has in Europe. And you can see certainly that there was a slowdown in transactions in 2020, which is the second bar to the right on your screen. But not a very, very dramatic slowdown, so down 28%. Which is, I think, probably not bad if you consider the level of disruption to our lives that was caused by the pandemic. But it is an underperformance when you compare to what the market as a whole did in 2020. The European real estate investment market wasn't down by the same extent in 2020. And where are we year to date? Well, we're down 15%, which again is a little bit of an underperformance. The entire European office market is down about 10%. And actually, if you take the basket of all the assets that RCA tracks, income producing and development sites, the whole of the European real estate market is actually up by 6%. So a little bit of an underperformance, certainly on those year-to-date numbers. And why is that? Well, I think there's certainly something to do with the caution that we're seeing in terms of investors' attitudes to the office sector, as Andrew's already pointed out, and the mass experiment and home working that we're all subjected to. I'm at home today in London. So what are we seeing, though, if we drill down sort of on a city by city basis? So this is the investment volumes in across Germany. What are we seeing city by city? Just on the year-to-date comparison with 2020 and 2019, I'll bring that up in a second. But there are 4 markets of the 8, this big 7 or the A cities where we're ahead of last year's investment volumes. So Cologne, Berlin, Munich, and Frankfurt. In Frankfurt, in particular, there's been something of a recovery and quite a marked recovery in office transactions. I mean, some of that's down to some, one very big transaction, which is the trading of the Tower 1 building. But nevertheless, those are deals that are being done and they're on the books and they're in the system. And so there is a bit of a recovery that we are seeing. But if I overlay the 2019 data, so that's pre-pandemic, it was the peak of the market, certainly in terms of transaction volumes. You can see that actually, with the exception of Frankfurt, where 2019 was a little slower, all markets are down versus that 2019 number, so versus that pre-pandemic benchmark. And again, some of that has to do with some of the caution that's crept into the market, some of the polarization in investment demand. And just to sort of take a step back, actually, and think about, okay, so where do offices sit within the wider investment landscape? Because I think that's what we're talking about, really. We're talking about, are investors going to be adding more offices to their portfolio, or are they pivoting elsewhere? And the data tentatively suggests that they're pivoting elsewhere. Certainly, if you look at the proportion of capital allocated to offices across most of these European countries I've got highlighted here, UK down versus 2015, France down versus 2015, which is, again, just a pre-pandemic benchmark for us, Sweden down, and actually across Europe down as well. So across Europe, if we look at the proportion of capital that was allocated to offices in 2015, it was around 40%. So far this year, it's around 30%. So we've seen a 10% reduction. And actually Germany, I'll just highlight that so you can see it there. Actually, Germany is the one market, with the exception of the Netherlands, where there's something slightly different going on there. But if we ignore the Netherlands for now and we say, well, actually, Germany is the one market where actually office investment has held up pretty well and is actually on a par with that pre-pandemic benchmark. Yes, down a little bit in terms of the total percentage of the capital allocated in 2021 versus 2020, but not by much. So it stands out as a market where investor demand certainly looks a little bit more resilient than elsewhere. And I guess that's something that the panel can talk about later. And just, broadening that out again and thinking about, okay, so where do German offices sit in terms of the investment landscape across Europe? Well, they are the number one asset class. If you look at investment volumes, if you look at the proportion of market activity they account for, now that peaked at just under 12% in 2019, but it has fallen somewhat. So around 9% of all activity across the European investment landscape this year was in German offices. But it's on a downward path there. And you can see the comparison there with, for example, the apartment market in Germany, which is certainly on an upwards path. And it's the same for the industrial sector in the UK, for example, which has overtaken UK offices as the biggest sector in the UK this year. And that's because of some of that rotation we're seeing out of offices and retail and towards the industrial market, towards the apartment market, and towards some other niche segments of the market. And just thinking about how attractive is the German office market to cross-border investors. So this is looking at cross-border capital, so buyers buying outside their home country. So in this case, it could be a French headquartered investor buying a German office, a UK headquartered investor buying a German office. Well, actually, in terms of its attractiveness, the German office market falls to third position here, actually below UK offices and UK industrial. The UK office market was traditionally the number one market in Europe for overseas investors, but post-Brexit, it's been on a sort of downward trend, which is amended upwards slightly this year. And what does that say to us? Well, the market in Germany is much more domestically oriented than in the UK, for example. So we're on around a 60%. Oh, there's my alarm going off. We're on about a 60% domestic demand in Germany. In comparison, the UK is more like 30%. So last couple of slides before I hand back over. Who's buying? And I've got it split here between the domestic and the overseas players, so you can see the mix between them. 𝗣𝗲𝗲𝗸𝗏 and Allianz at the top there, and that's really down to that one deal I mentioned earlier, the Tower 1 transaction in Frankfurt. And I'm not going to go through all the names here, but what I would say is I'd draw your attention to the bar chart on the right-hand side of the screen, which is the change versus a pre-pandemic average. So all these players have significantly ramped up their office investment thus far in the first 9 months of 2021 in comparison with a pre-pandemic period. So when we're thinking about has the pandemic changed office market forever, well, there are some investors, and obviously these are the investors who are spending, but there are some investors who are doubling down on the German office sector and are relatively bullish about the segment into which that they're buying assets at the moment. Notably as well, down at the bottom of the chart, I've just starred three investors there, and those are overseas investors, admittedly all European and neighbours, German neighbours, but they've all entered the market for the first time since the start of 2020, so post-pandemic. But what is, a little bit of this, some of this reticence, some of this uncertainty about the future due to pricing? Well, actually not very much at the moment. Our hedonic yield series, which is a modeled yield series, shows prices moving out, yields moving up very, very slightly for the A cities, but by 10 to 15 basis points, not very much at all. And that's mirrored in both London and Paris. So yields largely flat over the last 18 months. And I think that's certainly mirrored with what people are seeing on the ground. Final slide, but there are some differences that are emerging. And I think, one of the truisms that's coming out of this period is that investor preference seems to be focused on the better quality assets, centrally located with good levels of amenities, good environmental credentials. And so we're seeing a price gap emerge between the CBD offices, which is the light blue line, and the rest of the Germany offices, which is that darker blue line. So a greater price gap than normal, and certainly it reached a peak at the end of 2020. So that suggests to us that there's a degree of polarization creeping into the market, which wasn't there before. Okay, so that's it from me. A couple of minutes overdue, but hopefully I won't get told off. So I will hand back to Andrew.
Thank you very much, Tom. Thank you for the fascinating introduction there. I always learn so much from these impulse presentations. So, Charles, if you would like to lead the discussion.
Great. Thank you very much indeed, Andrew. Very good, very concise opening there from Tom Leahy. And in fact, it raised a couple of questions in my mind, which I hope we'll be able to get back to later on in the course of the session. But very, very clear as to what's happening in Germany in the last 18 months. And that's what we're going to hear. That's what we're here to talk about today. The German market, the European markets, what is happening in the office market. We've got a very good panel lined up here today. We have from Europa Capital, we have an investor who looks out across all of Europe. We have a workspace provider and consultant in 𝗀𝗽𝗲𝗍𝗏. We also have hard-nosed investors from Edmund de Rothschild and Edmund de Rothschild Real Estate Investment Management. So we've got a good cross-section of views here this afternoon. And we're not going to solve all the problems, obviously, but there's no doubt about it that the office segment is the one in institutional real estate investing that has got the most questions hanging over it. We've seen as Tom highlighted in his slides there, assets being invested in logistics, into residential, and also, of course, into strongly performing sectors of the weaker sectors like retail, but grocery anchored, food anchored retail has been a strong performer as well. So today we're going to look at offices, and I'm hoping to learn an awful lot here myself, because I think it's the area where there is the least clarity at the moment as to what's happening in the market. But before I start asking some questions, perhaps, of our panelists. Maybe I'd like to ask them all just in 1 minute, very briefly. I know Andrew did mention who they work for and the jobs, but if you'd please just define your own role in about a minute. And I'd like to start with you, Vanessa, if you would just tell us briefly what you do.
Sure. Thank you, Charles, and good afternoon, everybody. So yes, absolutely. I'm Vanessa Muscara, Head of Research and Strategy at 𝗀𝗲𝗹𝗲. As the name suggests, we are a pan-European investor. We manage a number of closed-ended value-add funds, and we recently also launched a core plus open-ended fund. We are majority owned by one of the biggest real estate companies on the planet, 𝗀𝗲𝗲𝗍𝗃 Corporation, who in turn have an AUM of 100 billion. Other than that, my role is to do with the top-down view and supporting the fund managers in their decision-making process for both the value-add and open-ended fund business lines. I'm delighted to join today this debate. Thank you for having me.
Great. Marcel, will you tell us a little bit about you and 𝗀𝗲𝗹𝗃?
Yes, good afternoon, everybody. Thanks, Charles. My name is Marcel. I'm responsible for running 𝗀𝗲𝗹𝗃's business in Germany for the 4 years. 𝗀𝗲𝗹𝗃 is I would say, pan-European integrated development platform. So we are active in Central Europe, in London, and then it's now for 4 years in Germany. So developing more than 1.4 million square meters. So in the last more than 2 decades, more than 800 people on board, covering the whole development cycle from the acquisition through the product design till the property management. And happy to join this panel and discuss today's topic.
Very good, very good. And Stefan.
Good afternoon, everybody. My name is Stefan Shah. I'm working for Edmond de Rothschild REIM. That's a relatively new player in this world. EDR REIM, they have been put together a European platform in the last years with managers from France, Switzerland, Germany, UK, and Netherlands. I'm covering transactions in Germany, and we are focusing mostly on offices, residential and industrial. And historically, we have been more in the core plus value add section rather than the core section, which is why this question, how is an investor like us doing an office investment these days is for us very challenging.
Well, challenging is a good opening word. I just wanted to ask you all, in fact, would you say that your jobs, or please just describe whether your jobs have become more of a headache since the pandemic or since the onset of the pandemic? Challenging is one thing, but has it all become an awful lot more difficult? Marcel, I see you smiling there.
Well, I remember back in March 2020, when company after company, and especially I think the youngsters, the startups and tech and e-commerce, they were announcing, okay, we are going fully digital. We don't need an office anymore. So of course there was a time when people were raising the question. So my line is, let's be honest. So the definitely pandemic strongly challenged the purpose of the physical space of the office as such. But what we witnessed months after months, and the pandemic continued, you see the totally different picture after a couple of months. So I'm pretty sure that actually after a couple of months it became more and clear that actually pandemic underlined and confirmed the purpose of the physical space. So that for the company the physical space is actually critically needed. You want to raise it?
maybe in a certain way, Marcel, the line of business that you are in as workplace providers and consultants and designers, different to the other panelists, but maybe this is right up your street, in fact, for the future of a business like yours. I'm just looking at the kind of projects you've done, and as we'll get on with in the rest of this discussion, a lot of the new forms of work and so on are challenging the very nature of the office. What about you, Vanessa? Has it made your life more difficult?
Maybe seeing the glass half full, actually. It's quite the opposite. It's made it far more interesting, but perhaps what's happening is that there's less of a focus on forecasting and more of a focus on monitoring structural changes. So I wouldn't envy any econometrician at the moment having to forecast what's happening in the moment. Just, I guess, I spent 15 years forecasting 150 markets across Europe, anything from Paris offices to Milan logistics, whatever. And the gentleman who actually taught me how to put an econometric model together told me to throw, economic models out the window because it's all about structural changes. So if anything, the systemic shock on the one side has made our jobs more challenging, but also more interesting. And I'm not saying that by the end of the day, as you were suggesting earlier, that we'll have all the answers, but we're in the process of seeing a change that will take decades to figure out where the supply and demand drivers will stabilize going forward. But yeah, in summary, less focus on forecasting and more on structural changes.
Structural changes generally implies big winners and losers ahead. So I would say, Stefan, what are you doing to ensure that you're not going to end up on the loser's side?
Yes, thanks. Well, I think for me, there are three perspectives here. First of all, I think there is a return perspective, and whilst in the past we had a fairly good outlook in terms of rental growth. I mean, there was, I think, a common sense that rents would still grow, at least in Germany, where vacancy becomes smaller and smaller. So the underwriting challenge was in the past not as big as it is today. Today, I think the uncertainty on rents and therefore, as a consequence, also on yields it's more shaky. The whole capital market is not so clear anymore. So that's certainly something which provides me a little bit of a headache, I have to admit. I think then the second perspective would be the space. So as you said before, how does the space look like today in comparison to the past? And I think this level of creativity for us is a very positive challenge, because we like to kind of get our heads around and find more creative solutions here. So I think that's a positive challenge, as I said. And then thirdly, I think location. I think there was a little bit of a trend in around 2020 where only the CBD locations really were in the focus of investors. I think this is now opening up a little bit, and I personally believe, of course, in the urge of creating outperformances. What sort of locations are interesting, and if you look at the famous 𝗀𝗲𝗹 strategy, A location, a B city, and a B location, an A city, I would probably focus now more on a A location, a B city, rather than a B location, an A city. So that's a little bit my summary of my outlook in terms of investment activity.
Is that because you're viewing the B cities as fundamentally more stable?
Compared to a few A cities, yes. I think that B cities have been suffering from decreasing vacancies because of a systematically low rental level, and at which rental level it was hard to build. And I think this is now opening up a little bit, but not enough. So therefore, I think a B city is a defensive play, at least if it comes to how big is the potential downward shift for rents. That's certainly one thing where you can have a defensive strategy if investing in B cities, yes.
That's assuming we're headed to a long-term downward shift in rents in certain sectors. And
No,
maybe
it's not assuming this. It's assuming that we are not having this kind of clear picture anymore, which we had before the pandemic. I think that, as I said before, we have to today. I think it's not entirely clear how rents will develop either in A cities or in B cities. But if I look at the level I can fall from a 40 euro level in an A city compared to a 12 or a 14 euro level in a B city, I choose the latter one.
Right. Vanessa, when you sit down and you look out across the landscape, what are you looking at? Are you looking at a future of further falling yields? Are you looking at the market diverging between classic trophy style assets on the one hand in the office sector, and perhaps even stranded assets of the second, third, fourth grade, which have and if so, is that good? Does it provide opportunities for you, or are you thinking, oh my goodness, we need to be starting to shift our resources entirely into another sector? How do you see it?
Yeah, absolutely. I mean, partly my job is to identify opportunities for both our business lines, core and value add. I guess in terms of repurposing, technology allowing us to live our lives more flexibly. There's far more opportunities for the flexible side of the value add side of the business. But in terms of breaking the whole argument down, the way we look at it is we split the argument into cyclical drivers and structural drivers. So by cyclical, I mean supply and demand, and structural drivers, I mean the shift to more remote working. So if we break it down, when we look at cyclical drivers and starting with supply, if anything, the pandemic could not have happened at a better time, in the sense that the future pipeline is far lower than the historic net additions to stock. So I think we've got about 2 million square meters of per annum space of office space in the pipeline across all European markets, as opposed to 3 million square meters historically. So reflecting much tighter fundamentals. There are a few exceptions. There's Berlin, for example, which has much higher pipeline than it's had historically. But even then, Berlin boasts some of the lowest vacancy rates in Europe at 4.3%. And Germany as a whole, the office markets there have very low incentives. I think it's about less than 10% of headline rents, as opposed to other European markets like France and Italy, which are lower 20%. So on the supply side, it's very, very tight. So that's good. I guess the big question mark is demand. And this time last year, I was sort of pulling my hair out because some of the forecasts I was reading range from a short-term forecast of minus 50%, and then in 10 years' time, a plus 10% increase in demand, which to me, basically that meant that nobody knows. So I think what we need to do in the short term is focus on what we can do, meaning reshaping supply in terms of changing customer expectations. We call them customers now as opposed to occupiers in the context of office leases getting shorter and shorter. Because another thing that's happening is, that we see more and more demand for space as a service. So I think there's more scope to shape in the short term the supply side of the story, meaning providing offices, as Andrew was saying earlier, that provide the right amenities, the right ventilation requirements, the right green specifications that meet the commitments to the Paris Agreement. So I think in the short term, what we're seeing is a shift from what used to be location to location and experience and green credentials. And then perhaps in the long term, when demand will be redistributed across cities, as we do live more flexibly as a result of the technology allow us, then at that point, location will become a driver of performance again. Because we will have the option of where we work, how many times a week in the office, how many times a week from home. So at that point, when that trend has settled, then location will become a driver of performance again.
That, of course, is the big unknown. how occupancy rates will perform over the coming years. There's a couple of quite scary figures that are out there. For example, the IMF have said that if there's a 5% rise in vacancies in offices, there will be a fall in valuations of 15% over the next number of years of office properties. Moody's say, or Fitch says that if people are going into the office less than 3 days a week, valuations of offices will be down by 50%. Moody's, rival to Fitch, says 20% of offices in the United States are going to be empty by 2022. That's 1 year away from now. I mean, are we deluding ourselves in the medium term? I hear what you're saying about the long term, and then that's when location will come back into the game. But in the medium term, are we deluding ourselves as to how many people are going to be occupying all those offices?
Yeah, I mean, no doubt vacancy rates will increase in the short term. You know, organizations are trying to figure out what their space requirements will be. And there's so many variables at the moment. You know, the large organizations, the Goldman Sachs of this world, are saying, you know, come back to work, remote working is an aberration. Morgan Stanley's saying you can go to the restaurant in New York City, you can come to the office. But then you've got, you know, your independent consultants that can choose to work everywhere. So there's that. And then we could also see space being taken off the market. I think perhaps we should be less wedded to offices being called offices and more looking at workspaces as a whole, which could be offices and CBDs. And we talked about polarization earlier. Absolutely. We still believe that the winners will be offices highly specified, all the environmental specifications in the CBD. But there is also a space for workspaces further out within cities. I think, you know, if you think bigger picture, top down, already we're seeing a shift of mayors across Europe attracting, instead of corporates, attracting residents and talent in the process by providing them a better quality of life. There's a real undersupply of housing at the moment, but if you attract the right type of residents, then they come along with consumption, with the property taxes, and so on and so forth. We've seen, you know, the likes of Paris and Mrs. Hidalgo and her advisor, Carlos Moreno, implement things like the 15-minute cities. And for anybody who's studied planning, that's another way of saying the polycentric city. It's no news, except that in a world where we're trying to sort of reduce carbon emissions, you know, having a better quality of life and having amenities within a 15-minute walk, being the place where you live or the place where you work, healthcare, education, is a sustainable way of living. And so what does all that mean in terms of the implications of things like a 15-minute city on offices? Well, it's interesting. It could be something called the third space. A guy called Roy Ottenberg, he's an urban sociologist, and towards the end of the 80s, he came up with the notion of third space, meaning the first space.
After your home, after your work, and then a civic amenity that benefits the city.
Correct.
Well, I'll tell you, we've got somebody here whose business is all about that. And Marcel, I think at this stage, if some of our audience don't know about the very specific nature of your business, they may well know in cities like London that some of the developments that your company has made, and in Eastern Europe certainly. And I'm here in Berlin, and we are all very fascinated by the whole rejuvenation of an old industrial complex. And in fact, Stefan, this is a subject must be very close to your heart as well, since earlier on this year you financed a similar old red brick industrial area. Tell us a little bit about, because this Marcel, this is very much in the world of workspace and what Vanessa is talking about, war for talents and getting people to. So go ahead, please. I mean, I think a lot of people will be very interested.
Actually, I like this split. What Vanessa made at the beginning to look at the from the cyclical perspective and then from the structural. And the structural, I will come to the end and exactly looking at the office as a purpose of the office, because as many times in the past, always the disruption or the crisis not necessarily brings the new things, that just accelerated the trends which were there already before. And already before pandemic, the employers started to realize that the office space actually is not necessarily the cost factor for my organization, but it's much more the productivity, the engagement, the attraction, and retention factor. It's an HR factor. Yeah, and actually, what COVID did, it's just accelerated that trend. Yeah, what do you hear today? Of course, we have the technology, and you can work from almost everywhere. Yeah, to do the work, to communicate, to call your colleague, to organize the Teams meeting, you don't need to physically to meet. Yeah, but when you realize how you manage the company, the research is saying that there are 4 areas which is super difficult to do digitally. Yeah, when you are the leader, you need to build the culture within a company, and without the physical space, without something when people are really physically meet, it's quite challenging to build the company culture digitally. Yeah, that's when you are the bigger organization, you have a lot of teams, and you need to build the trust between these teams. And we are human beings, and if you are looking to the screen, it's quite challenging to build the trust in relations between the teams which are competing, which have the issues, etc., etc. You need to put them together, and again, especially when it comes to the creative work, because let's be honest, yes, when it's a repetitive work, which is individual work where you don't need interaction, home office and digital can work quite well. But as you become the organization and you need the interaction, you need something to create something to come to. It's the physical platform become pretty much essential. And also the learning, that when you have an onboarding, when you have new colleagues, when you need to share information and all the learning curve. We are human beings, so it's super challenging to run this in a digital way. So the long story short, what we see also in our experience, that the purpose of the office is changing, but we also see, as you say, the district, our project in Berlin, it's not small. It's almost 50,000 square meters, and we are fully leased. During the pandemic, companies realize that, and we talk to HR person, even some of them are asking for more space than they originally asked. Here the structure they are pretty diverse. Yes, you have the companies are saying we will go hybrid model 4:1 or 3:2, and then potentially we need 10 or 20% less than we originally thought. But you have the companies that acquired the same space, or even looking for the more space exactly for those reasons. Looking at their OPEX structure, look at the typical OPEX structure of the current employees in the consultancy. The people costs 70-80%. The occupational costs 8-10% typically in the Germany. So I'm not saying that they are not price sensitive, but I'm saying that really the main focus is, as Vanessa said, to attract the talent, to retain the talent, and workspace proves to be perfect tool to that.
In the UK, it's actually 90%.
Pardon?
So in the UK, a typical business, 90% of operational costs are salaries, and 9% is rent, and 1% is energy costs. So absolutely, it's all about attracting talent to the right product.
Well, when I was just preparing some notes for this webinar this afternoon, Marcel, I started exploring a little bit, and I found out that you are founding members of the Well Living Lab. Now, for those, I'm going to give you a little plug here, because actually I strongly suggest to a lot of our listeners or our audience to go and have a look at what's going on there. This is a joint collaboration between Delos and the Mayo Clinic. Many of you may have heard of the Mayo Clinic in the United States, very specialized top doctors. And on the campus of the Mayo Clinic, they've set up the Well Living Lab, which has been collecting tons and tons of data on the whole impact on human health of working in indoor environments, sound, heat, warmth, but to the very furthest, most progressive degree. And I can honestly recommend people to go and have a little look at this, because it seems to be very clearly the future of offices. And I presume as founding members, you get access to all the latest data, research, and so on that's coming from them. It's really quite fascinating. Stefan, your company also took on what we would have considered, an old style investment in Berlin, the 𝗀𝗲𝗃 as a financier. Now, was that one of those decisions that you said this is interesting because it doesn't fall into any of these classic categories? What was the thinking behind the company behind this particular? It's also an industrial complex turned into the most modern, about to be presumably most modern office complex for all these great talents that we're warring for.
Yeah, most of all, I have to clarify this. We're still very, very happy about this investment decision, which we took at the time. But I think that the view we are taking today is a little bit different than the view we took at the time when we bought it. I mean, I want to say something. This building is 130 years old, and it was serving, I think, over this time, I think, in many purposes. And therefore, I think what Vanessa said before, it fulfills entirely this kind of definition of a workspace, rather being kind of specified as an office space or a production space, etc. So this building always offered this sort of flexibility to be used in any way, which it can be because of his structure, his ceiling height, etc. So, but kind of coming back to this project, how we looked at this at the time when we bought it, which is actually just 2 years ago, and how we look at this today. At the time when we bought it, this was kind of, Berlin was I would say in a very much boom mode, and you had vacancy, which you just had to refurbish and then lease up, especially in an attractive building like this. So it was more of an asset management skill. I think today we have a little bit of a different picture. I think today this building shows even more potential than at that time, because it really fulfills for all those HR people the chase for talents, that it is in a fantastic environment which offers the employee not only working inside but also going outside. It's from its architectural perspective a beautiful building. And I think it, as I said before, it offers a high level of flexibility what to do with the space. If you have 4 meter ceiling height, you can basically do everything and offer your tenant every solution he's aiming for. So I think what we're looking at this today, we are probably studying a bit more options, alternatives, what we're doing with this, how we're developing this space further than we did 2 years ago.
Okay, well, again, that's the kind of space like Marcel's and what Vanessa was talking about, neighborhoods, 15-minute cities, clusters of the talents. But it leaves an awful lot of other office properties in a very difficult situation, doesn't it? I mean, a lot of the classical office properties, surely they're facing, or their investors are facing, a very bleak future.
Yeah, I think, Charles, you might need to help me here, because in Germany, I call this a little bit like a 𝗀𝗽𝗲𝗹𝗲. I don't know what this would be in English.
Basically, the sort of big clump of an office building, all with a single tenant in it, 37 floors.
Exactly.
Yes.
So I think those buildings who probably from a today's perspective offer less charming atmosphere, etc., and who also offer a high level of rationalization. I think there I would be a little bit more careful about how this tenant might extend my lease or might not extend my lease. I think somebody said this already at the beginning, compared to those buildings like, for example, the 𝗀𝗲𝗃𝗃, which can offer a variety of nice premise creation.
Yeah, because it's not that easy for a company that owns that rents the whole building, if they want to move from, say, owning or occupying all 37 floors to saying, actually, we now only need 20. And what happens then? And if it's in a fund somewhere, and this is this is, I guess, maybe directed a little bit at you, Vanessa, because you run funds, but it's what is going to happen with a lot of these funds that are holding these properties, and in 10 years' time or in 8 years' time, some of them have long leases. There's no extension of the lease. The investors fall off a cliff, don't they?
Well, absolutely. I mean, we're definitely seeing a shortening of lease lengths in the office sector. So if you look at the portfolio implications of that, 20 years ago, the INREV or the MSCI universe was 85% composed of offices and retail. Fast forward today, it's 65% logistics and residential, and that's partly as a result of lease lengths getting smaller, suggesting that landlords can no longer afford to be passive managers of offices on 20-year leases. In fact, there was a study released by MSCI earlier this year looking at the UK office universe, highlighting that 60% of leases will expire within the next 5 years. So we've got 5 years to think about what to do it. But another trend that's really, really interesting in the UK is that the government is tearing apart the book of class uses. So what used to be called just offices is now actually being called commercial and business space, which means that as long as the use of it is commercial, then you can change a space from, say, an office to a pub, to back to a retail or to a gym without asking for planning permission. And that fluidity brings a higher level of occupancy with it, which is what you want. And, you know, flexibility is another way of saying resilience, which is what you need in an investment. So allowing flexibility of use.
You do tend to have greater price visibility in the UK, I would say, than you do in certain other markets. For example, most people suggest that for a lot of office properties, there has been a discount of 10, 15%. That's almost accepted. We're not seeing any of that in Germany. At the moment, the official story is everything is holding its own value. So my question, I guess, to all of you is, are we all kidding ourselves? Are we conning ourselves here about the future of a lot of the existing property, not the more modern office properties or the 𝗀𝗽𝗻𝗃 style offices, but with a lot of the others? I mean, do they not face a bleak future? And don't when they don't get extended, do all the investors not suddenly take a massive hit very quickly?
So if I may to
please, Marcel, please
comment on that, because there is always, when you look and you paint some super aggregate data about the whole Europe, about the whole world, and it's always then you are so high level that maybe you then get the different message. I think when we look at the Germany and any other market, it makes a lot of sense to look at the city markets. And yes, that might be that some cities, also including Germany, might see in the future either stagnation.
We haven't even talked about ESG yet, and I know that it is something that is occupying nearly all CEOs' minds. From
So even in some cities, you might see the stagnation on the reduction of the demand for the office space. But when you looked, I think 𝗀𝗻𝗃𝗃 and 𝘀𝗽𝗃 they did some analysis, and what they did, they're looking at the 2030, and they're looking at the demand for offices, and actually they are just analyzing the population growth in the city. So not population in Germany, but migration population in the city. Structure of the economy, which obviously will go, it's going step by step towards service, white collar economy. And point 3, they pictured the base case scenario and pessimistic scenario, and factor in how much the working from home will kick in. Yeah, so. And even in the pessimistic scenario, they are seeing either stagnation or even slight growing demand in in the offices in the next 10 years. And in the base case, they see, I think, the 10% over the next 10 years demand, simply driven by the growing the labor, the employed in the offices, and overall growth of economy. Yeah, but I agree. It was mentioned before that we will definitely see the split between the high-end, top quality products, and we will see the struggling 20, 30, I think 50% of the stock, if I'm not mistaken, is more than 20 years old. So that's this definitely will play the role when you are the employer and decide where to go. Obviously, you will take the building which fulfills all the well-being criteria. I didn't have the chance to comment that why we are so obsessed about the well-being and why we are the founding member of the Well-Living Lab. And this is exactly because then we get access to the data based on which we can design the building which are fitting the user needs when it comes to quality of air, the enough of daylight, when the right amount of greenery, and all the factors which support the well-being and overall happiness and engagement of the employees.
Well, Marcel, that may be so because that's your business and you're at the very peak, you're at the very cutting edge of this business. But for other investors, even if, as you say, the demand figures by 2030 suggest there's going to be a great deal of demand for offices still, or for white-collar workers, somebody has to take the risk of buying those assets or investing in those assets to comply with, and you're not talking even ESG there, but other investors are scared stiff of investing in assets that do not tick every single box, and then they're going to turn some third-grade office property into a fully ESG compliant property, meeting all the well-being needs and so on, is going to demand a huge amount of extra investment, isn't it? The question is for all of you, and I'm sure this is something that you think about all the time as well, Vanessa.
Yeah, absolutely. I mean, you can either play, there's core and value add side to it. You can either play the core game, which can perhaps be the relative game. You know, for example, in the UK, yields recorrected post-Brexit, and they're still much higher than some of the other yields in other office markets. So if you're looking for yield, then you can do that. Otherwise, if you're a value-add investor, you can afford to take on a little bit more risk, and you look at the story bottom up, and you look at the possibilities there for repurposing, which could go anywhere. There's plenty of opportunities. It's just how flexible you are, the planning,
and how flexible your financiers are.
Yeah, absolutely. And I'm not being an advocate of buying offices. I'm being an advocate of developing a product which complements itself with surrounding uses as well. So at the moment, what we're seeing in terms, for example, in London, in terms of redistribution of demand as a result of more remote working, there's one trend in the centre of London, which started before the pandemic. We're seeing the rise of membership clubs or members clubs, which are targeted at select audiences. So it's less about drinking and more about, the Soho houses of this world are all about attracting the creative industries. So journalists, architects, and you can have a coffee there, but you can also work there. Or you have the Conduit, which is all about attracting entrepreneurs who are into saving the planet. Or you've got the Albright and the Wing, which are all about, women's only members. And you can actually work there during the day and stay in the evening for an event. And then what we're seeing slightly outside, and this is coming back to the argument we were talking about earlier about third spaces, is that for those days that you do choose to work from home, so slightly further out, but you don't have adequate spaces at home, then there's something called the Art Club. And it's fascinating to see these business lines popping up. And what they are offering as a service is the idea that you can go around to a working space and hire a space for a day, for an afternoon.
Vanessa, it's good that you talk about that on the very day that the daddy of all these co-working concepts finally manages to get itself onto the stock market for a $9 billion valuation, down from 49 billion or 47.5 billion, which is what the world thought it was worth 18 months ago. I think we'd all agree, Stefan, are you looking, co-working is a big theme, right? So when you're looking at not just the Osramhöfe, but other assets, how big a role does co-working play in your mind?
Well, I think I'm sitting here myself in a co-working space in Munich, and it's not one of those large groups like WeWork or Regus. It's actually a small boutique style WeWork co-working space, and I see this also as one of the big trends coming up, because I think that it becomes more and more common that smaller teams are setting up offices or branches in cities, and people learn that this kind of setting up an infrastructure and having its own office is much more expensive than paying the price of a co-working space. So I think that I'm a big fan of co-working, so to say. But also I think that for a big office building, which is probably min 20,000 square meters, I think a co-working element could be very beneficiary, because it actually allows the larger tenants to, let's say, breathe a little bit, to shrink, to grow, and without being forced to move out. So I think we're going to see this more, even though, as you mentioned before, WeWork and Regus, I think they are not in a perfect shape. But this is because probably that this is just a very, very, these are very big companies with a very large concept. And I more believe in individual concepts which are more adjusted and
that's what
situation.
Vanessa has been describing, this kind of setup where there's a whole variety of subsets of types of work, life, living, which is what gets us back to what you're talking about, is major structural change, Vanessa.
Yeah, absolutely. It just depends what level of risk you're willing to take. You can either, if you can find, the prime asset which gives you a 20-year lease, then that's great. You can afford to sit on it for 20 years. The reality is that leases are getting shorter and shorter, and occupiers are looking for more amenities and spaces of service, being able to at the click of a button, being able to book space for a few hours. So that's the two extremes. But as portfolios are becoming, the share of traditional leases is decreasing, and we're going more towards operational real estate, then even within that you have a range of risk you can take, from your franchises all the way to being owner occupied. You have a choice of how much you want to be as an investor exposed to the profit and loss of an operator. But yeah, the reality is that we are moving from a world to leases of traditional sectors, offices, retail, and logistics getting shorter and shorter, and more towards real estate being used as a service. And so then at portfolio level, it becomes more of a question of what is the right balance in terms of risk of traditional versus operational risk.
Well, talking of risk, I risk getting Andrew's eagle eye on me if I don't pass over to him and ask him what questions, or do we have questions coming in from the audience, Andrew?
Yeah, there is a question. It actually relates to what Tom was saying earlier. It's a question from 𝗀𝗲𝗶𝗀, our old friend, talking about that what you were saying, Tom, was presenting a sort of contracting of CBD yields. And he says that JLL does not see rental growth. Smart offices required substantial investments of construction costs are increasing. And how do you respond? He says as an office developer, but that's not just for Marcel. How do investors respond to this? And if you just want to touch on that, Tom, I think as it was based on your presentation.
Well, we're reporting on what the data shows. So I guess it's not up to us to say how should investors or developers respond. I mean, they've got to make their own decisions based on their data and their outlook. I mean, the data I was showing was illustrating that there's this sort of polarization, it seems, in demand from the buyers who are buying office assets, which is a refocusing on the core. And that's why prices for those CBD assets have kept rising through the pandemic, whereas they've stalled for those assets that are in less central locations. And I would use less central as probably shorthand for maybe less desirable from an occupier perspective. And so that's why we're seeing that polarization happen. But I mean, we've had a lot of discussion about why that might be through the panel.
Yeah, and the construction costs increasing. I'm guessing for smart offices in particular, the need for technology is challenging. And I wondered, Marcel, how are you approaching this whole question of smart buildings, and Stefan as well, in terms of what you're doing?
Well, okay, there are two questions in one question. So the construction costs and the smart office. So regarding the construction costs, well, it's a headache for everybody who is these days constructing, obviously, and I think all the sector are witnessing quite some increasing construction costs thanks to our integrated model. So the part of our company is our internal general contractor. So the team of the people who are taking care for last 2 years for example, our project here in Berlin. So the majority, the high percentage of the supplies were contracted before this last month's dramatic increase. So one way of that is to integrate it into your organization and manage the risk and split it to supplies to much smaller packages, and then managing the quality and the costs going forward. Of course, then you need to be realistic in your business case to what extent you can reflect it to the future rents and how to position your product. When it comes to the smart features or smart solutions, so within 𝗀𝗲𝗹 is what we did a couple of years back, and I think it was mentioned already. I think Vanessa mentioned that we are looking at the space not only as a square meters to be given to the tenant, and here it is, and we're renting it. So we start to look at it as a workspace, as a service, as a part of that. So one thing is consultancy to help the tenant to create a workspace strategy, even to help the tenant to know what they need, what reflects the DNA of the company, how the proper space should look like in order to fit to their culture, to fit their business model, etc., etc. And the part of this offering is also the tool of the various smart features which are part of the fit out, and then how I would say that how forward-looking the tenant is, then we can provide various solutions as a part of the fit-out package. You have more traditional tenants who are looking maybe more so seller offices and not too keen on the technology. You have really forward-looking tenants who would like to have the interpositioning, who would like to have the various gadgets measuring the environment, the easy access, flexible parking, all the technological solutions are there, and it's at the end about the dialogue with the specific user, what it's the best fit for their team, for their culture.
Excellent.
Okay.
I have a question, if I may, a very quick one to Tom, based on his slides and the information you gave earlier on. I mean, I may have missed this, Tom. But did I understand correctly that you said actually Germany is down 15% year on year in office investment this year, whereas the rest of Europe is actually up?
Yes, yeah, that's correct. Yeah. You're looking at the entire market across all asset classes.
Isn't Germany supposed to be the safe haven, the repository of all wise investment money? Why is Germany underperforming the rest of Europe?
Well, I think it's the German office market. So it's not just Germany. I think, one of the things we're seeing, certainly in our data, is sector preference, I think, overrides most other investment decisions at the moment. I think once you decide on your sector preference, then you're looking at which markets and cities to go for. And so when we're saying the underperformance is really office-based as opposed to...
So you're saying, sorry, I may have misunderstood you. You're saying Germany office investment is down 15%, but the rest of Europe is not up.
No, the rest is. The rest is.
It's up in office investment also.
Office investment, no, is down as well. So
down as bad as Germany?
We're saying that the very strong demand at the moment is focused on apartment and industrial property in particular.
Yeah, no, I was trying to get a comparison of the investment in German office as against other EU or other European cities.
Okay,
or other European markets. Is there a direct comparison?
Yeah, it's a similar picture.
Okay, so it's not an underperformance.
No, it's an underperformance.
The sector underperformance.
Yeah,
I get it. Yeah. Andrew, any other questions? I'm conscious of the fact that one of our panelists here needs to jump on a plane. But are there other questions, Andrew?
Yeah, there's a couple of questions about hybrid and co-working. Ksenia asks, will hybrid co-working and hospitality and edutainment real estate concepts, that's a new one on me, gain more traction in outdated real estate operating development practices? And Tristram Frost says, if there will be more hybrid working in offices, how much less office space, he's asking for a very rough estimate, will be needed compared with pre-pandemic in Germany across Europe? And if less space is needed, how will that impact yields and rents, which I think we've touched on a bit?
Yes.
But it's really that sort of hybrid co-working, I'm going to try and say that again, edutainment real estate concepts.
Just take the first bit of that question again, Andrew, and maybe we can get a quick response.
Will co-working and hospitality concepts gain more traction in outdated real estate operating and development practices? So I guess the question is, will there be more need for specific space for that type of user, and will that be different, and will that fit in with the previous older buildings, I think?
Vanessa, a quick response maybe from you?
Yeah, absolutely. Is what I was talking about earlier. I think we should be less wedded to just talking about, the traditional offices, the ones that investors were very privileged to be able to sit on for 20 years when there was such a thing as just having, being the owners of bricks and mortar in a 20-year lease. Now it's no longer the case. I mean, we no longer refer to our occupiers, we refer to them as customers for a reason, because they require that additional level of amenities. So all of a sudden it's become a lot more active asset management. And there's also, I guess, a place in that in benchmarking as well. So our value add funds are absolute return driven, but our core fund has to be a benchmark. And if I don't hold many grudges in life, I promise, but I do hold this one, which is that many of the benchmarks, the INREV and the MSCIs of this world, don't offer as many shades of office sectors to allocate new acquisitions to. So whereas over the 20 years, we've seen residential being further split into senior housing, student accommodation, all with their respective drivers, for offices, we still just have offices, when actually we have things like life sciences, which at the moment are experiencing a really high level of demand.
So what you're saying is that there's a danger there of people loading up their indices with assets which are not pure office, and therefore showing a false or not representative outperformance. Is that right?
Correct. I know for a fact that our peers in the Odyssey Index, which are all core open-ended European funds, are allocating life sciences to the office sector. Which it could be an underperformer, it could be an outperformer, depending. Right. Life sciences actually are in very high demand at the moment because they have very sticky, in high demand by investors because they have very sticky tenants because of the high cost of the fit outs. So I suspect they're outperforming, but sitting from where I'm sitting behind a spreadsheet, I can't tell that at the moment. And it's really quite frustrating, as opposed to, maybe even a flexible office with an operator there. That's also being allocated to the office sector. But that has its own drivers and range of risk profiles depending on how much operator risk the investor has chosen to expose themselves to. Is it a management contract? Have they chosen to be an operator investor? There's all these nuances that at the moment behind a spreadsheet and a screen, it's really hard to identify any reasons for any under outperformance because we're just so rigid within the definition of office.
Well, you've certainly flagged something there that I'm sure, I don't know if you've taken it up directly with people like INREF, but you've flagged something there that I think is something to be noted, and the temptation is obviously there, obviously. Stefan, a last word from you, perhaps on that same question about other uses. I think we've kind of covered it. Andrew, just remind the last little sentence there again.
Sorry, that question was dismissed. So I'm going to have to go. It was basically talking about hybrid co-working concepts within older buildings. I
think we have pretty effectively covered that. With an eye on the clock, I'm actually going to hand back to you, Andrew, because we did say we would try to keep it within the allotted time span. So I will thank you all very much for a very interesting, very lively discussion here. And I've even preparing for all this, I've learned quite a lot, got some new perspectives. And one of the perspectives I'm taking away with me is that people are already stopping thinking of it in terms of pure office and are moving on, seeing it as a very different kind of a service element, which is not measured purely in terms of price per square meter. That's been a very clear takeaway here for me. So thank you all very much indeed. I'm going to hand back to you, Andrew.
Thank you.
And thank you all very much indeed for
thank
a good
you, Charles.
discussion.
And I'd like to thank our panelists as well for a very interesting discussion today. Vanessa Mascara from Europa Capital Partners, Marcel Sedlak of 𝗀𝗲𝗻𝗀 in Germany, Stefan Shah, Managing Director of Edmund de Rothschild, REIM, and could also thank Tom Leahy from Real Capital Analytics for his introduction to today's topic. Thank you also to everyone in the audience. We look forward to seeing you again on the 17th of November when our next Investing in Germany Roundtable will be examining the future of urban working and living. Until then, please stay safe and a good afternoon to you all.
Thank you all very much.
Thank you.
Bye now. Bye-bye.